If you're running a company in China or planning to start one, understanding taxes is absolutely critical. In this video, I'll break down the China tax system for Chinese companies, including tax status, main taxes, export VAT refunds, and key deadlines. This is a short, complete, and practical guide for 2026, especially for foreign invested export companies in China. So let's start with a very important concept, the tax status of Chinese companies. In China, every company falls into one of two categories, a small-scale taxpayer or a general taxpayer. This classification directly affects your VAT rate, your reporting obligations, and whether you can get VAT refunds after export. Now, what is a small-scale taxpayer? A company qualifies as a small-scale if its annual revenue is under 5 million RMB. The VAT rate on domestic sales is 1% of your turnover. However, if your quarterly revenue is below 300,000 RMB, the VAT rate becomes zero. Also, the VAT rate for exports is zero, but small-scale taxpayers cannot refund input VAT after export. VAT reporting of small-scale taxpayer is done quarterly. Now let's look at the general taxpayer status. This applies to companies with revenue above 5 million RMB per year, or companies that choose to upgrade voluntarily. You can upgrade anytime, but it is important to understand that once you switch to general taxpayer, you cannot go back to small scale. The VAT rates for sales on domestic market are higher, 13% for goods and 6% for most types of services. VAT reporting is done monthly. The main advantage is that general taxpayers can credit input VAT for domestic sales of goods and apply for input VAT refunds after export of goods. Many companies assume that becoming a general taxpayer is always better, but in reality, this is not always the case. First, reporting becomes a bit more complex and accounting costs increase. Also, VAT reporting frequency increases from quarterly to monthly. Second, VAT rates are significantly higher for domestic sales. Small-scale taxpayers pay 1% or even 0%, while general taxpayers pay 13% for goods and 6% for most types of services, although they usually can deduct input VAT. So, when does it make sense to upgrade? It makes sense if your revenue exceeds 5 million RMB, because in that case it becomes mandatory. It also makes sense if you have significant purchases with VAT invoices, if you regularly export and plan to claim VAT refunds. Otherwise, staying a small-scale taxpayer is often simpler and more cost-effective. Now let's go through the main taxes your company will pay in China. The first one is corporate income tax, also known as CIT. This tax is calculated based on your net profit, which means your income minus documented expenses supported by the VAT invoices, also known as FAPIAO. The rates in 2026 are as follows. If your annual net profit is up to 3 million RMB, the tax rate is 5% of your net profit. If it is equal or above 3 million RMB, the rate is 25% of your net profit. It's very important to remember that expenses without FAPIAO are not deductible. Corporate income tax is reported quarterly, and the deadline is the 15th of the following month. The next major tax is value-added tax, or VAT. VAT is calculated based on the amount shown on the VAT invoice. For small-scale taxpayers, the rate is 1% or 0% if quarterly revenue is below 300,000 RMB. For general taxpayer, the rate is 13% for goods and 6% for most types of services. For export, the VAT rate is 0%, with the possibility to apply for a refund of input VAT. Reporting is done quarterly for small-scale taxpayers and monthly for general taxpayers. In addition to VAT, there are also surcharges. This includes an education surcharge of 5% of the VAT payable and an urban construction tax of 7% of the VAT amount payable. There is also a stamp duty, which is calculated at 0.03% of sales and purchases contract value. When you hire staff in China, including director, there are following obligations. You need to pay individual income tax, which is deducted from employees' salaries. The rates are progressive, from 3% up to 45%, with a monthly deduction of 5 1,000 RMB. You also need to pay social insurance, which is mandatory and usually starts from around 1,900 RMB per month per employee. There is also a housing fund, where both the company and the employee typically contribute around 5%. For foreigners, the housing fund is usually optional. So now let's talk about export rules. For export, VAT usually is 0%. To receive a VAT refund, the company must be a general taxpayer. Also, the company must have customs registration, access to the electronic customs system, registration with SAFE, which stands for State Administration of Foreign Exchange, and a foreign currency account. It must also have proper export documentation. Exporters must provide a valid customs declaration proving that the goods have physically left China, along with the VAT invoices and proof of foreign currency receipt, transportation and customs broker service VAT invoices. Tax authorities also check the office, the presence of employees, company accounting, whether the company pays its taxes, and so on. The deadline to apply for VAT refund is 36 months after the export. Finally, let's go through the key deadlines. Corporate income tax is reported quarterly. VAT is reported monthly for general taxpayers and quarterly for small-scale taxpayers. Employee-related taxes are reported monthly. In most cases, the deadline is the 15th of the following month or quarter. To summarize, choosing the right taxpayer status is critical. Small-scale status is often more suitable for smaller businesses. However, general taxpayer status is necessary if you want to reclaim VAT on exports or offset VAT on imports or domestic sales. If you're planning to open or optimize your WFOE in China, understanding these basics will save you both time and money. If you need accounting services for your Chinese company or a consultation, you can contact us on WhatsApp.